Hi everyone, and thank you for joining us today for our webinar on real estate trends in 2024. Allow me to introduce myself. My name is Andrew Jordan. I'm a business development manager here at Drooms, and today I am very excited to be joined by our panel of expert speakers as we look to dive deep into the evolving dynamics of the real estate market, reflecting on past predictions, the current challenges that we're facing, and the technological advancements shaping the future of real estate transactions. So what I would like to do, first of all, is invite our lovely panelists to introduce themselves one by one. Yama, we'll start with you.
Yeah, hey everyone. Thanks for having me. I'm Yama. I'm the CEO of Westbridge, the leading ESG and sustainability advisor in the European real estate market.
Thank you. And Timo?
Good morning, everybody. My name is Timo Chamle. I'm founding partner of Twain Towers, an advisory company which offers supervisory, advisory board and senior advisory mandates.
Thank you, Timo. And Elaine?
Yeah, hello, good morning. My name is Elaine Wilke. I'm an independent consultant and I advise international and institutional investors and corporates about real estate, about transaction strategy, but in the last few months, especially about all the ESG topics and regulations.
Thank you. And let's look to get started here. Now, firstly, I would like to know a bit more about our audience. So I do believe there is a poll available, and I'd like to know, what is your current job role? All available there. There we go. Should be available for everyone. So we have a lot of brokers joining us this morning. Oh, others. Not many lawyers. Obviously mustn't be getting paid by the hour today. So it seems like other and broker is the most popular choice. Okay then, so if let's look to get started and involve our panel a bit more. So our first question today is reflecting on 2023 predictions. How would you say that the market realities in 2024 have differed or aligned with your expectations? And Yama, I'd like to bring you in first here and get your thoughts.
Yeah, so we are now 9 weeks in, I think. So to be honest, and to keep it short and crisp, and no good news for our brokers, this year won't be any different to 23, to be honest. We'll be facing a couple of aspects, for example, still high interest rates, still pressure on financing, refinancing, value adjustments, insolvencies, restructuring measures, and ESG, of course. And this is probably the only thing which is the same for the past years and for the coming years, and that won't change, and it's the ESG part.
And Elaine, anything on your side?
Yes, as Yama already mentioned, I think rising interest rates and the consequent withdrawal of debt from the market led to repricing and poor performance. So I think the valuation uncertainty has been the overriding theme, leading to big gaps in asking bid prices, and especially in the commercial sectors like office buildings. And this has been, as you know, reflected in a precipitous drop in transaction. But I think the availability of debt and equity will be significantly limited in the coming years. And at the same time, considerable capital will be required not only for refinancing, but also for the transformation of real estate, especially to comply with ESG requirements. And so I think the market participants are therefore more careful than ever about how and where they deploy capital, and although most part of the real estate sector, as I can see from my conversation with my clients, is still waiting, but experience from the markets, past market cycles show that these phases of also very good entry opportunities for anti-cyclical investors. But overall, I think the investors who will benefit the most also next year or this year are those who think along with the ESG and digital transformation and ultimately create the most marketable properties. But I also think there's unlikely a single timeline across the Europe diverse market.
Well, for the second year in a row, Drooms have actually done a survey with real estate experts from all over Europe about their perspective on the transaction markets and their own investment plans in its latest real estate transaction barometer. And it's striking that across the whole of the European markets, more than 70% of respondents did state that the average transaction duration of a real estate deal has increased in the last 12 months. And that being said, I'd like to ask our panel now, what strategies have proven effective in navigating the increased duration of these property transactions? Yama, do you want to jump in there?
Yeah, sure. So I think a couple of aspects which we need to take into account, Elaine just mentioned, right? So a couple of risk factors which you need to think about. But when it comes to speeding up the process, it's more and more about data and having access to data, having greater access to market data for the respective districtions and jurisdictions. And when it comes, in my terms, it's quite relevant when it comes to ESG and ESG data. When you know what you're talking about and when you know what the asset is at the end of the day, it's quite okay to have a speedy process. What we are seeing in the past years, it was just the market driving the transactions, and now you need to work with the assets. And there's a little bit of work to do in every market, and I think to increase the duration of processes, it will end in you have to have accurate data.
Thank you, Yama. Anything else to add there, Elaine, perhaps?
Yeah, I mean, we talked about the ESG transformation, and I think, I'm advising a lot of investors handling with ESG issues, and I mean, within the last month or 2 years, we have different regulations we have to take into account. The SFDR, where you have disclosure obligation depending on your ESG strategy, the classification of the financial product according to Article 6, 8, or 9 of the regulation. We have the Corporate Sustainability Reporting Directive, the CSRD, which also increase the disclosure of corresponding ESG data, also for the owner-occupied properties, not only for the investments, but also the banks. They have more disclosure regulation. They have to disclose, for example, their green asset ratio in the future. And all this together is based on different ESG related data and information. So in the future, we don't only have these traditional financial, tax, legal, or technical due diligence. We also have to perform a separate ESG due diligence. But that's actually the big challenge here, because for the other due diligence, there are appropriate standards that have been established over the decades as to which data, documents, and information must be provided in a transaction. But actually for the ESG due diligence, on the other hand, it's quite hard because you don't know the seller, they don't know exactly what kind of information need to be provided. And on the other hand, you have the buyers who have different requirements for their ESG information and data. And this will also have an impact on the entire transaction process.
Brilliant. Thank you, Elaine. And just to jump back to our transaction barometer, the respondents identified that the DACH region at 65%, the UK coming in at 42%, and the CCE, or the CE, apologies, region at 28% as the most promising markets. Timo, I feel like I've left you out a bit there, so I'd like to put this question to you to start off with. Which regions do you think are currently seen as the most promising for the international real estate investments, and why?
Yes, you did leave me out. Look, my international investment times lay well behind me, so I'm not sure if I'm the best one to comment on that. However, I was not surprised when I saw the results of your investors poll, because it's a natural reflex that in different market times, investors will concentrate on those markets which are mature, which are transparent, which are professional, which provide an easier environment to generate equity commitments and finance. So since those markets have been reflected in the answers, I was not surprised. That said, there are differences. The UK, for example, is much quicker when it comes to adapting new price levels. So the market-to-market mechanisms there function much more fluent than, for example, in Germany, where you have a different valuation regime, let's say. That said, obviously the result should be the same, right? The valuers should come to a price finding which is reflecting a working transaction between a willing buyer and a willing seller. However, in the absence of comparables, that can result in a slowdown in reflecting new price levels in a German regime. So I think investors looking for revised price levels felt more comfortable finding those quicker in the UK than elsewhere on the continent, especially in Germany. If I may, Andrew, go back one step, because I'm not so sure that we are right when we emphasize the ESG theme as the overarching theme for investors as we speak. By that, I don't mean to ignore climate change and the challenges which it injects into our industry and the severe need to change our behavior and the way we think and build and trade. But I believe it's fair to say that there are overarching pain points. And one of your earlier questions was comparable of the predictions made last year for this year and the findings in 2024, or the beginning of 2024, compared to those. I would say that the biggest single prediction, and at the same time, the biggest single hope last year, was a change of interest rates. And that's a very mono-dimensional perspective. We come out of an era of cheap money. We all knew that it had, obviously in hindsight it's easy to say, we all knew that it had to change one day, but then we were, I guess, and that counts for myself as well, also surprised by the speed and the steepness of the steps which we witnessed. So to now hope that this returns into a more friendly environment, or maybe even back into money is for free schemes, I think is an illusion. If you look at the different inflation rates indicators, if you look at other market indicators, there are a lot of arguments that the steps in the lower interest direction will come later and be smaller than we all think and hope. So that's quite a heavy weight load on the market shoulders beginning of 24. And this stands in an unholy alliance, if you like. Yeah, what we've seen last year were the wipeouts of the first developers. Obviously, they stand in the first row when the bullets hit. But that's not over yet, not over for developers, unfortunately, but also not over for other players. So what do we do if the trouble infects the stockholders? What do we do if the current trouble infects the financing banks? And I think that's still to come in 24. Not witnessed yet, beginning of the year, but with attention holding tight. I think those are the biggest mispredictions, let's say, of last year, which will have to be corrected this year.
And Timo, maybe one aspect to add is sustainability and profitability will go hand in hand going forward. So there's pressure coming from not just financing banks, also from tenants, and so on. And what we are seeing, because you just mentioned it, value adjustments in a new normal pricing, which we haven't reached yet in Germany. Brown buildings will be penalized with price reductions. So there's no green premium anymore. And so therefore 2024 will be a year of ESG and ESG investments.
Yeah, I mean, if you ask a hairdresser if you need a haircut, the answer is clear.
Yeah.
So I'm not neglecting the need for sustainability and ESG measurements. What I'm saying is that if you're an investor who's facing insolvency, you will put your equity into measurements which will defend you against insolvency before you put them into measurements which pay into the ESG strategy of your portfolio. That's all I'm saying. Yeah, both is important. Both is a burden for society, or in the not for society, in the interest of society, and therefore a bigger theme than the success of a real estate development or investment. That's clear. But I'm talking about the emergency modus we are currently witnessing, and within emergencies, it's clear that for some time at least, selections of preference and the urgency might shift away from mid to long term shifts in strategies such as ESG and sustainability, where we still stand at an early stage of what we will see as an evolution, I think, compared to what you have to handle within the next quarter, or you go bust. End of the story. Yeah, so I think that's the head-to-head race we are currently seeing in the industry.
Anything to add on that topic? I feel like there was it was certainly interesting to hear the two sides.
Yeah, probably because we talked about most promising international real estate investment markets. So I think Timo is completely right. So other markets were more radical in value adjustments. Also the US, also the Nordics, but nevertheless, so Germany will not be a market to avoid in the future, right? So once we have achieved a new normal, we will see transactions, and we will talk about the asset classes later, I think. But back again to an ESG perspective, I think Germany is already an international pioneer. We have a strong economy, we are a leading market, and we are a bit faster than other markets when it comes to ESG and to green buildings. So hopefully, and I think this will be something we are seeing in Q3, Q4, that the momentum will just speed up. But fully agree. So we are seeing investments into bigger markets like Paris or London, but Germany will play a role in the near future again.
Thank you, gents. Now, our next question here revolves around cross-border investment plans. Now, before we jump into our next discussion, I'd actually like to ask the audience. It's our second poll of the call, and the poll is as follows. What are your plans this year for cross-border investments? Are you planning to scale up, scale down, or invest the same amount as last year? I'd be interested to see the answers on this following on from our discussion. Okay. So as it's coming in, we've had just over 20 responses so far, and the same and scale down is currently level pegged. but there's still a solid 25% are looking to scale up. So that's a rather promising indicator. Wait for a few more responses to come in. Relatively equal across the board then. Scaling down is got a slight lead, but 31% evenly for scaling up and keeping the same. So our respondents of our barometer actually came up saying that over 51% were looking to scale up. So perhaps in the short scale of time between the barometer and this call, there may well have been a change of opinion. So moving on to our next topic here, Yama, last year you actually shared your thoughts on the appeal of Europe, especially the UK actually, France and Germany as prime spots for cross-border investments, pointing to international capital flow and the emerging asset classes like data centers and life sciences as key drivers. Now, considering the evolving investment landscape and your observations on the strategic shift towards alternative financing and equity, I would love the opportunity to hear your views.
Yeah, so I'm not the best expert for cross-border investment and financing questions, to be honest. But what we are seeing is that there's a decrease of ES3 requests when it comes to transactions, and there's a decrease in, for example, building certificates for new constructions. Yeah. I think we've talked a little bit about the other markets a couple of minutes ago. And probably a good way to talk about new asset classes. So what we will see is the living sector. What we will see is investments into infrastructure, also investments into data center. But when it comes to cross-border investments, probably one thing which I can say is that at least we scared off one potential buyer nation. For example, the Koreans in Frankfurt, at least, right? So what we need to do is to build trust again. We need to build trust, and probably 2024 could be a good vintage year for real estate investments in all relevant European markets, such as France, UK, and Germany.
Timo, any opinion on that at all?
Sure. If you look back in time, the balance between national and international investors in Germany is somewhere between 60-40, going one way or the other, but always around that balancing point. And last year was a year where, from my point of view, especially German investors within their home country were more paralyzed than other national investors on their home turfs. Yeah. So if you compare, for example, how much investment and acquisitions French national investors have conducted on French territory, then that's substantially higher than looking into the biggest German institutional players on German ground. And that said, a lot of hope for 23 came along with the degree of equity. So the market at the beginning of 23 thought that insurance, for example, insurance money, pension money, family office money, all those entities which are not dependent on finance that much, not dependent on a high leverage that much, would save the market. And they didn't. They didn't. They sat on their hands. Most of them sat on their hands. Some big insurers, for example, financed more in real estate than they bought. Others sold instead of buying, and that's something we shouldn't forget what's happening in their backgrounds. They do have in the statutory rules, they do have an asset allocation which is fixed. And if prices move and markets slipped, then they have to have a look at that balance, at that allocation. And then it's an automatic, let's say, rebalancing act, which goes on behind the scenes to bring that asset allocation back into the balance which they have underwritten. So if markets like last year fall deeper and deeper than the real estate market, despite the fact that real estate markets and prices have fallen as well, they will anyway shift away from real estate into those other asset classes, taking dry powder, taking acquisition power away from the real estate. And this is what happened. If you look into the big German insurers, this is the story they will share with you. It's transparent, it's no secret, but it's an characteristic and item which have been heavily overestimated as a hope factor for last year. Same for, just to close it, same for the German open-ended public funds. A lot of them reconsidered the market. A lot of them were, let's say again, paralyzed because they couldn't find offers which reflected what they thought would be a fair sales price. And since that gap is huge, and you do see, Andrew, some of the questions coming up from the audience, it's not a German phenomena. There are still big gaps between offering and asking prices. And if they don't meet, then they keep liquidity and they can do it for rather long. And they did last year. And this is something which moves into 24 as well. My prediction for 24 when it comes to the nationalities and money employed is that the German deployment on German territory and German ground will be substantially higher than last year. But still, if you look into 23 last year, the biggest deal was a retail deal conducted by Slate Asset Management. So a Canadian player coming into Germany, deploying more than €1 billion in one single portfolio transaction. So there are international players with appetite, with dry powder, and with the guts to act while Germans were waiting. And I think that's something we will see again in 24 to some degree.
Maybe I can add, it's the same when I talk to my clients. I can also see that against this uncertain economy, that at least for the moment, there are still concerns about real estate retaining its status as a favorite asset class, and that some of them, or for my investors, they are reducing their real estate allocation in favor for fixed incomes, bonds, and so on. So that's the same that I see with my clients.
And when it comes to private money, as Timo said, you know, there are now other solutions and other ways to invest money. So in the past years, it was real estate in terms of higher returns. So there are different ways to invest now, and this is what we are seeing. Yeah.
It's good to see agreement across the board there. Always pleasing. I'd like to move us on to our next topic now. And technological advancements have significantly transformed the landscape of real estate transactions, impacting both the efficiency as well as the security in multiple ways, especially in view of the rapid rise of AI and machine learning. Our next question to our panelists is, in what ways do you think have technological advancements impacted the efficiency and security of real estate transactions? And Elaine, I'd like to put this to you first.
Yeah, I mean, when we leave out all the other topics, I think that after ESG, I think AI, technology, digitalization are seen as the second top trend for the future of real estate. But I personally see IA more in the development of real estate or in the entire property management chain, like marketing, letting of real estate, rather than in the real estate transaction. But it's also kind of a marketing tool, as AI is more likely to speed up the trend to be in a more central, high quality office to attract, for example, young top talents, which will be even more focused on creative collaboration, exchange, and so on, while a lot of the, let's say, day-to-day routine work is being done by AI.
Thank you, Elaine. Yama, anything to come into?
Sure. We are seeing, increased investments also in PropTechs and stuff, right? But it's not enough. So if you want to have a change, right, and especially when it comes to data and data accessibility and, gathering data, analyzing them, trying to make best use of data, we need to invest into PropTechs. And, Timo just told us you need to prioritize your investments. That's crystal clear. But when you have a little bit money, just do it and just invest into PropTechs. Just help them to create a new kind of new normal, a new market, or a generational shift in our industry. Because we need to change. The past 10 years have been great, right? But now it's time for a change, and it just goes with digital tools. It just goes with data, and it goes hand in hand with sustainability, AI, and so on and so forth.
Andrew, let me add, in times of limited resources, let's say, if it's capital or is it qualified staff and HR resources, you have to choose, right? And you can delegate either to people who might be rare when it comes to qualified staff, or you can delegate to systems. And those systems go along with some need of investment. And I'm with Yama there. I think that across the prop tech, maybe construction tech, fintech scene, we've seen a lot of good ideas which move into that dilemma. Yeah, so they do offer solutions, intelligent solutions, and smart in a sense of resource allocation as well. To those points, we need answers to. It's still early stage, and again, where do you deploy money when times are tight? But some of those investments have been paid off quicker than a lot of either investors or corporates who then have deployed those products have thought. So yeah, I believe that's a trend to continue in 24 as a result of a lack of alternatives. You do have to think about digital transformation as well if you want to be or want to remain, let's say, fit for business in the current environment.
Thank you, Timo. And moving on to the next topic, given the current market overview that we very much have highlighted in the duration of the call, how do you think that real estate professionals should pivot their strategies to adapt to the evolving landscape? And I'll open that up, whoever wants to jump in first.
I can start if you wish.
Of course.
I mean, what are the strategies which are tested, let's say, at the moment? Obviously, you've seen a little bit of a shift in asset classes, partly with tailwind from the past Corona time window, right? So the logistics market, which profited a lot, the residential markets, which had a little bit of I don't want to say hype, but they had quite a good time. And that remains and continues. On the other hand, there are new investment strategies, or newer, I should say, investment strategies, which get help from capital allocations, which are, let's say, how do you say, state of the art, yeah? So if you think about transformation of obsolete residential into green, into ESG, that's compared to other asset classes like a traditional office with a potentially uncertain future if stranded already. So that attracts money, and there you have a liquid market on the offering side, and there you have willing sellers who do have to admit that the capital expenditure they would have to inject to make those stock holdings fit for a future business again might overwhelm them, and hence book values are down already, and it's sellable. And yeah, you find parties who concentrate on that. So I think that these are some live examples with newer strategies which fit well into environment with all its ups and downs, and find interested money to push it.
Makes complete sense. Elaine, I know you mentioned earlier about speaking to your clients. Have you had similar feedback from what you've heard?
Yes, I think when investors still want to be active in the real estate sector, especially if they have the corresponding capital available, then from my point of view, I think they should use the time and follow the credo. ESG compliance is not a nice to have, it is a license to play. And as we already heard before, it's quite important to create the most marketable properties when you have the ESG compliance. And but I think at the moment, most of the people, they look at the renewable energy and all the topics about energies, but I think they also should take into account the topic of biodiversity, which is unfortunately still an underestimated topic, but I think it's one of the key elements in the real estate sector, and it offers a lot of opportunities for implementation, far more than the let's say just bees on the roof of a building. So you can do a lot and use the time right now to get your assets ESG ready, and so you also have not only a positive contribution when it comes to the aforementioned disclosure requirements, but also it will help you to create the most marketable properties.
Probably to add, you know, it's just the industry view, and probably it's too narrow, and you know, we need to think much broader. It's not just ESG, it's not just, you know, financing and assets. It's what we are seeing is change of direction, especially from the regulation side, especially in Germany, right? So what you need to take into account is, and you need to be a little bit more flexible in your strategy, is the macroeconomic realities, what's happening in the countries. For example, Poland, in the past year, Poland was just, you know, that country in this PE market to invest in, but now it's the closest border to one of the biggest wars, right? So this is something what you need to take into account, and it's not just about numbers and returns and yields, it's also about, you know, having a bigger picture and taking everything into consideration.
Thank you, Yama. And as we move towards the end of our panel discussion, before we do start our live Q&A, excuse me, I'd like to add that according to the Transaction Barometer, the most attractive asset class for 2024 in the respective home country in descending order were logistics and industrial, coming in at 34%. We then had residential in at 20%, healthcare 10%, office and hotel coming in at around approximately 9% each. But around 33% stated that different national regulatory requirements were the biggest hurdle for cross-border property investments, following up with a lack of the local market knowledge and current interest rate level. Now, I'd like to ask our panel, in their opinion, which real estate asset class do you think will offer the most opportunity in 2024, and which one's going to lose momentum? Timo, let's go straight in.
Okay. Yeah, I'm not going to repeat what I said regarding managed ESG and transformation in Resi, but I think that will continue in 24. But let me pick up on logistics and industrial, which you mentioned top of your list. Just to give your audience a little bit of insight, let's say, yeah, what happened there. Logistics, as I said, came out of a curve with a lot of tailwind after Corona, right? Was flavor of the months, yields going down heavily, rents going up. So it was, let's say, a perfect storm for some time. And yeah, to allow you a little insight behind the curtain, with Twin Towers, I've been advising a family office, which is a developer. And the first institutional logistics project was close to its delivery, and we gave it to the market. So we are talking about a liquid size, we are talking about a good location, we are talking about a platinum certification, We're talking about a long blue chip tenant, ESG was covered. So all boxes ticked. And we had a handshake deal at a multiplier of 32. But that was prior to the ink being dry below the lease contract. And it was prior to us receiving the building permit. So we said, okay, 32 is fine. We get back to you once we have both documents done and dusted. And then two things happened. Ukraine started 2 years ago. And obviously the first steps of the interest rate change happened as well. So we sold substantially later, which is summer of 23, not beginning of 22 when we had the handshake, for a multiplier of 24. So we lost 8 multipliers. And still, with a multiplier of 24, we conducted one of the most prestigious and most priciest logistic deals last year. But you lost, just as a matter of fact, as a result of the interest rate mechanics, 8 multipliers. So how come that your investors still say, hey, hold on, industrial and logistics will continue to be interesting for us? That's a result of the overall gross investment costs and construction costs you have. Because even in the current best price environment, you still have a gap, let's say a positive gap, and some defensive distance between your total costs of development, land, you name it, all in, and the current market prices. So if you can sell for 24, but you build it for, I don't know, 14, 16, 18, depending where you are and what you do, that's still a juicy profit. And this is partly why the interest stays so high.
Thank you, Timo. Yama, Relayed, anybody want to jump in and add to that? I'd love to hear your thoughts.
Yeah, I fully agree. So living will play a huge role for real estate investments. You know, there is still a bright spotlight on that asset class. So, you know, a growing world population, cities and countries becoming more urban, structural changes in society. So there are a couple of trends. You know, living sector will be and will remain a key asset class. Also logistics, I think, great insights from Timo on that side. On the office sector, I think, you know, it's at the end of the day, it will be a war for tenants. So not for talents, it's tenants. And what we, you know, always in big cities, what we will see is investments in grade A core assets in bigger markets won't stop. But when you go into suburban regions, metropolitan regions, it will be quite difficult for the office sector.
Me too. I also agree, and I think that niche operational sectors will dominate the sector rankings, underpinning the different kind of global mega trends. But I also think that ESG probably may help to open up a new world of potential investable products in other niche areas, for example, battery storage, renewable energy, solar farms, and so on, electrical vehicle parking. So kind of quasi real estate investment. And on the other hand, I think there are also new ideas or advancing ideas around the co-location, which means that you're combining different use in single buildings or location. For example, when you talk about residential, it will become more mixed use with amenities or service apartments. So asset classes that create places which will feature multi-use spaces that attract different kind of generation, different types of user. And I also agree that the office still need to transform itself, also providing for different alternative use, like we said before, life science data center and so on. So I think that will give some more opportunities in the future.
Thank you, Elaine. And as we reach the end, what I'd like to do is now I'd like to have a look in the chat. We have some questions that have come in from our guests today. So I'm just going to have a quick scroll through. And Pergel has asked, what do you think about augmented reality? Interesting one. Would anybody like to jump in with that, Timo?
Yeah, I can, and I go a step further and combine it with the other question she or he posted around the tokenization. So first things first, augmented reality. I guess there are now some established use cases in the real estate sector when it comes to planning, when it comes to fit out, when it comes to saving, let's say, time and resources in the context of inspections and property tours. But that's it. Yeah. So I guess this is only the beginning of an evolution, and there will be more established use cases on the way forward. But so far, I don't see many more. Yeah. And I'm not talking about having digital twins of buildings and so on. That's, for me, that's not augmented reality. Yeah. So second question, tokenization of investments of properties and developments. There have been, to my knowledge, there have been a couple of trials in Switzerland, in Germany. They haven't taken off, as far as I know, yet. But I think that there are things happening as we speak, which will indirectly help to raise the acceptance of the idea of tokenizing real estate soon. So if you look at what happened to the Bitcoin and other cryptocurrencies, since the SEC has allowed around, 5 weeks ago, 1 month ago, the ETFs for Bitcoin, you can see how much institutional money is moving into such digital assets. Yeah, and obviously a cryptocurrency is one digital asset. A token of another real asset might come on the evolutionary curve behind something like the currency we're talking about itself, but it will come as well. So I think this is rather powerful in setting the scene for such shifts. And again, we're only standing at the beginning, but I think the time for tokenizations is to come.
Thank you, Timo. Anything to add on the panel with regards to the topic? So going back to earlier in the call, I'm just having a look through the questions here, and one of our guests has mentioned that in Austria there's still a major gap between the bid and the ask price, a massive spread. I know we have talked about that. Question is, what would you advise to an investor in order to explain the price impact to the seller? Would anybody like to step in with that? Nope.
So it was linked
You go.
to Zinshäuser, right? So I think it's the main reason is interest rates, higher financing costs, and also ESG, right? ESG measures. So these two factors need to be factored in going forward.
I think there's one mean element around the ESG question when it comes to finding the correct price point. If you have a Zinshaus or whatever kind of real estate, and you want to give it to the market, and you ask the brokers, okay, what's the price point I get with, for example, a gold certificate versus a platinum certificate? They will have difficulties, and I hope the brokers on that audience will agree, but they will have difficulties to prove the price difference between those two quality of certifications. However, they will rightly state that it's a must-have, despite the lack of price points to be given. And hence, coming back to the original question, how to explain it to the seller, you will not be able to explain it in a transparent manner that one certificate is X and another ESG status is Y. But the fact is that the risk of stranding, if you don't have any of that, and if you haven't pushed forward on the sustainability and ESG matters to some extent, it will simply, Yama, correct me, it will simply end up being not sellable at all, especially when you face institutional money, not private money. That's a different pocket, yeah, and they might not be victims of the same rules and statutory boundaries. But facing institutional bias, I think that will be witnessed.
Agreed.
So I think we've got time for one more question, and one's just come in actually, tying into sustainability. How is social sustainability being managed in terms of accessibility and inclusion in the building environments? And yeah, is this even relevant at the moment? I know that a couple of panelists have touched on, the current economic situation, and ultimately when you prioritize where you're going to deploy your capital, you've got, your motives that are important. But with regards to this here, yeah, how is social sustainability being managed?
I can start again if you like. I mean, if you look at ESG, we discussed the E, we discussed, or we didn't actually, the governance element, but that's old, yeah, or older. And the social part is rather new. So if you look around the German, and Miguel, I can't see from where you are asking, if from a German perspective or a different European country, but if you look around Germany, there's the ICG, Institute Corporate Governance, which has invested heavily into a push of a social real estate investment impact as well. So if you look around and want to see what's state of the art, I don't know if Elaine and Yama will agree, but from my perspective, that's the most advanced measurement and program we have seen in Germany, and it's open source, yeah. So you can have a look into the social real estate investment impact report, and that gives some guidance. What I do not know from the top of my head is the detail around inclusion and accessibility. Accessibility, I would argue that that's an older element of the parameters you look at when you want to be adaptable in a social manner. But yeah, that's a guidance I can give.
Yeah, and it's coming, right? It does play a role going forward, but it's not on the top of the priority list, to be honest. Probably, Andrew, one more question around ESG. So there's our lead and DGNB certificates, still the best ones. I think there's no obvious answer which one is better, right? So there's also BREEAM, so BREEAM DGNB. On lead and DGNB, I think both are working quite well. One is US, one is German. You need to decide which is more accurate.
Maybe to add to the question of the social sustainability, I mean, a lot of people just look at the assets and how it's accessible and inclusion, but it's actually quite wider, this topic. I mean, if you, for example, look at the construction of real estate and all the aspects, how the workers are treated to build the environment. I mean, that's not that big issue in Germany, but depending on where you build the real estate, you have to see where does the materials for the real estate comes from and how it is extracted, for example, how the workers are treated over there. So it's actually much more than just the building and the social surrounding or the working environment for the people within the building, but you also have to consider the whole life cycle of the property if you want to do it right.
Thank you, Elaine. Now, as we continue the everlasting impact of technology on real estate, the ongoing discussion, I'd like to remind everybody who's joined the call today that both Drooms as well as Westbridge Advisory will be at MIPIM, which is upcoming in the next couple of weeks, and we are both eager for deeper conversations. Our final poll of the call is, will any of us be joining us? We'd love to connect. So the final poll, will you be at MIPIM 2024? Yes, love to connect. No, but we're happy to have a conversation down the road.
What about being at MIPIM but not wanting to connect?
Well, unfortunately, we didn't offer that option, but I'll definitely have a conversation later on today and make sure that we include it in our future discussions. I assume, Timo, you'll be the first person to tick that box, right? I would also like to take the opportunity while everybody's answering the poll. Elaine, Yama, Timo, thank you very much for joining us this morning. We very much appreciate your opinions and outlook on the current and upcoming markets trends, and very much look forward to speaking to you all again soon. Thank you to our guests as well for joining our webinar, and there will be an on-demand version available, and it'll be shared to everybody who registered. Let's just have a quick overview on the results here. And okay, 35% of our guests joining today will be at MIPIM. I look forward to all of your Outlook invitations that I assume I'll be inundated with at the end of the call. Panelists, thank you very much, and I hope you have a great end to the week.